It is a type of share where one partner purchases the other partner's share gradually. Let's see how diminishing musharaka works. According to this concept, a financier and his client participate either in the joint ownership of a property, or an equipment, or in a joint commercial enterprise. The share of the financier is further divided into a number of units, and it is understood that the client will purchase the units of the share of the financier, one by one, periodically, thus increasing his own share, until all the units of the financier are purchased by him, so as to make him the sole owner of the property, or the commercial enterprise, as the case may be. Let's see a diagram, which will help to understand and illustrate how it works. The buyer wishes to purchase a house who do not have adequate funds. He approaches the bank, who agrees to participate with him in purchasing the required house. 20% of the price is paid by the client, and 80% of the price by the bank. The bank owns 80% of the house, while the client owns 20%. After purchasing the property jointly, the client uses the house for his residential requirement, and pays rent to the bank for using its share in the property. At the same time, the share of the bank is further divided into equal number of units, each unit representing equal proportion of ownership of the house. The buyer promises to the bank that he will purchase each of these units at agreed time during the musharaka agreement. The rent payable to the bank is also reduced to that extent. This process will continue until the end of stipulated musharaka agreement period, when the client purchases the whole share of the bank, reducing the share of the bank to 0, and increasing of the client's share to 100%.